Sitting and chatting with your ex-regulator. I've worn a suit today, especially for the occasion. I think people want to know who is Mr. Pramod Rao, the big brother of online bond platform regulation.
There are very few who welcome regulation. The online bond platforms were one of the few who did welcome it. Do you sort of shut it down, or do you sort of figure out a way to harness it? There is that Hindi saying, right? Der aaye durust aaye. So distribution network for how to have bonds reached out.
Number of trades, just to tell our audience, is on a trajectory to double this financial year.
I'm right now reading 1929.
Why is bonds very important for a portfolio?
Not just ecosystem, you could in fact impact entire markets.
What's next in store for Mr. Rao?
It is hard-earned money. I think it should be hard at work for you.
Very well said. Like a true regulator.
This content is for educational purposes only. The views expressed are personal and should not be considered as recommendations to buy or sell. Please consult your financial advisor before making any investment decisions.
Hi, good morning. This is Vishal Goenka, co-founder of India Bonds. And I welcome you to a very amazing session today with none other than a very distinguished and special guest today, Mr. Pramod Rao, who's given me the liberty to call him Pramod for the session. Pramod, welcome to the show.
My pleasure being here, Vishal.
A little bit about Mr. Rao. Until July 2025, he was the executive director at SEBI, where he was part of the corporate finance department, and importantly for today, debt and hybrid securities department. He was also part of EAD, QJC, enforcement department, and DEPA. He's held various roles in different national forums, including being the SEBI representative at the IFSC authority and NFRA boards. Prior to his life in public domain, he was the group general counsel for ICICI, also general counsel for Citi South Asia, and been a board member of ICICI Prudential Trust Company, which oversees the ICICI Prudential Mutual Fund and AMC. But apart from his regulatory background, he's been an ardent admirer of, follower of technology, and in fact, did a own startup called LawTech and been on board of a lot of startups. An amazing combination, a graduate from National Law School of India University in Bangalore, but a great combination of being a regulator, a general counsel, and also a big fan of technology. I hope that's a good long introduction of 5 minutes, but Pramod, over to you. The first question in everyone's mind, and I think this is your first public speaking event post your stint in SEBI, is what motivated you to move from the private sector to the public sector?
Thanks, Vishal. I would put it as two seminal things which happened in my course of my career, and this was when I was at ICICI. I got involved with the development of various digital public infrastructure, co-led by iSpert, which Sharad Sharma leads, and also Rahul Mathan, a senior of mine from law school, partner at Trilegal. And when they got me involved, suddenly one could experience ecosystem impact level contributions that one could make. So when the SEBI opportunity came along, to me, it was an extension of that. That suddenly not just ecosystem, you could in fact impact entire markets. And I think that that really led me from private sector to regulatory space. And it's been amazing.
No, absolutely. Sitting and chatting with your ex-regulator, I've worn a suit today, especially for the occasion. But what is a significant difference between the two? You try to achieve one for a large organization and one as a national policy for the country. What do you think are the stark differences in operation terms and how you think and how you implement things?
I would put it as two or three which indeed stand out in my mind. In a private sector, whichever organization you are part of, I think all your ambitions are to, how you enhance its productivity, how you enhance its revenues, profits, and so on. I think at a regulator, you tend to see a 360-degree perspective of any issue. You have various constituencies to safeguard, like investors, but also to nurture, such as issuers and intermediaries. And I think striking a balance between all these three stakeholders, primary stakeholders, is a must at a regulator. I think the other thing which astounds me no end, and indeed I've said that in many private conversations and also happy to state it here. I think in private sector, we have so many different, motivational tools, if you will, whether in form of year-end bonuses, stock options, maybe even foreign trips or vacations which are sponsored by the employer. In a regulatory system, please remember all of them do this without actually having a year-end bonus, without having a financial upside to the impact that they are having. So when you see them in public service, I genuinely think we have to doff our hat to that fact that genuinely people are interested in giving back and contributing at a policy level without having financial incentives to do so. I think it's really a distinguishing feature between regulatory and public. I think the final sort of observation I'll make is that in private sector, I think the level of satisfaction comes from how your organization is scaled. I think here the level of satisfaction comes from seeing how your market has grown, how the consumers have been safeguarded, how the investors have been protected, how much resource mobilization has happened. Whether in equity side, when we say that it's now reached we are number 2 in the world in terms of equity mobilization, but I don't think even on bond side we are too far behind. So genuinely, I think those are the things you take pride in or satisfaction from, is how I put it.
No, perfect segue, because today's conversation is going to be a lot about debt markets and bonds. And it all started really, and we can call you the big brother of online bond platform regulation. And I'm sure we have a very proactive and very good market regulator, which is looking at development and protection of investors in the country. But what is the genesis? What happened in November 22? I know you had just joined that here. What was the thought process that finally a regulated framework for online, I say online because that's technology enabled, came through? What was the thought process, if you could look back in time and talk about that?
I think, again, we should look back maybe even a year prior to 22, because one saw suddenly proliferation of online platforms offering fixed income securities. I think that sort of mushroomed. One could see a lot of investors signing up, a lot of tie-ups which potentially intermediaries were also contemplating with such platforms.
No, absolutely. This was the digitization move post-COVID,
Exactly,
right?
exactly,
Everything was getting
exactly.
digital, technology oriented.
And the minute one could see the growth of those platforms, the question was, do you, smite it? Do you sort of shut it down? Or do you sort of figure out a way to harness it? And I think the policy objectives were very clear, that one wanted to see democratization of the debt markets, one wanted to deepen it. Indeed, retailization fitted well within the policy purview. So then the question was, okay, how do we go about it? And I would say here, the online bond platform showed little bit of maturity, which I should say I'm grateful for. There are very few who welcome regulation. And I think the online bond platforms were one of the few who did welcome it. So the response to the consultation paper, the engagement thereafter with the regulator, sort of gave confidence to the regulator. Yeah, these are not fly-by-night operators. These are people who want to, sort of engender investor confidence, trust. And I think that momentum built up into becoming both the consultation paper and the regulations that followed. And I'm very happy to see how it's turned out. I understand now there are 40 plus online bond platforms, and all regulated, all under the auspices of a BSc or a NSC.
That's right.
And registered with SEBI as stockbrokers. So this is a compliment to those entrepreneurs as well who created these platforms.
I remember that, I think March 23, we implemented this, and there were barely 10 platforms in about 2.5 years. And you're absolutely right, because as an industry, and thanks to a proactive regulator, we welcomed it. We said, this will give us authenticity, this will regulate, this will streamline. I want to take a step back and maybe delve a little further. One thing was that there were a lot of platforms and you wanted to regulate. But why do you think, debt capital markets and efficient debt capital markets is important for the economy? Why do you think it's important for the country? What was the thought there?
So clearly, our country is in a period where we need a dramatic level of growth happening, and that growth gets fueled by capital. Whether that capital is equity capital or whether it's debt capital. I think clearly the businesses, the governments and so on, for doing what they do, require that capital. Debt becomes a far more efficient way for businesses to lever themselves, to be able to deploy that. Governments, by contrast, can only borrow.
Yes.
There is no
There is no
share that
equity.
there is no equity that they can issue. So clearly, to my mind, that itself is the biggest sort of driver. As they also sort of sort of realize that the domestic markets are sufficient to give them what they need, and we must compliment again Government of India and RBI. India is one country which has not actually issued foreign currency denominated GSEC.
Absolutely.
Right?
Yes.
It's been mobilized completely in country. And even when FPIs are coming in, they are coming in through the FAR route or whatever, which is converting their foreign currencies into local currency to actually buy these bonds. So, to my mind, that's something which I think we have nurtured, and it can only really grow from here on.
So apart from government securities, I think another segment is the entire private credit market, right? So a lot of funding, large scale funding to companies comes through some form of private credit and structured debt, and that kind of
Right.
opens the avenue. Any thought about how welcoming we are to FPIs in terms of corporate debt, private, and what was the thought process?
So I think we are, like I said, indeed in search of capital which fuels India Inc., which fuels various government programs and so on. So I think the welcome mat is indeed out there.
Mm-hmm.
In terms of both private credit and structured debt, as you said, I think for a long time post our DHFL, the ILFS crisis, a lot of paper has only got concentrated around double A and above.
That's right.
In the listed space, in what is even though offered on EBP and listed. And I think the private credit has rushed in to fill those spaces which are below that.
Yes, that's right.
For companies which are below those ratings. And yet, to my mind, it is helping evolve what I call a public yield curve.
Mm-hmm.
If those deals are also listed, then we will actually be able to understand that what is it that highly rated corporates can borrow at and what probably a weaker corporate is borrowing at. And that yield curve can really benefit us quite a lot. So I'm hopeful that, all of it comes together and is visible.
The next question is really for our audience. I know you've been at big industry forums, but being an online, mass retail platform, we have lakhs of users, which hopefully will see this and learn. If, in simple terms, you can explain why is investing in bonds or fixed income instruments important for a common investor? An average man says, "मैं equity करता हूँ, I know real estate." Why is bonds very important for a portfolio from an investor point of view?
I would put it as that maybe a balanced portfolio for an investor needs to have bits of everything, whether it is a bit of real estate, whether it's a bit of equity, and certainly fixed income securities, bonds. For the reason that they are supposed to provide a steady, regular income, whether in form of interest which is paid out and so on. And then finally, the return of capital at whatever interval that was agreed upon. I think that certainty of that cash flow coming at those regular intervals is what at least a bond can offer, as opposed to a equity, which, for instance, can indeed maybe deliver capital gains, but you require exiting it for achieving that. The companies could declare dividend or may skip declaring dividend. But a bond, once issued, indeed requires the issuer to service the interest, repay the principal. And I think that is the reason it should belong in people's portfolio.
And what do you think an investor should look for? I know very basic questions, but so that our audience understands that before investing in a bond, what are 2 or 3 main things a person should look for before investing?
I think clearly they have to match the returns to the risk that is embedded in the issuer, in the instrument. Clearly, higher the risk, higher should be the rate of return, rate of interest which one commands. Be watchful of the ratings. What is the rating agency sort of saying about that issuer? How is who are the various intermediaries associated? There is a debenture trustee, which is a mandatory component of any bond issue. What has their track record been when it comes to if there is a delay or a default by a issuer? And finally, it is that there is an embedded or there is an inherent risk of delay or default. I don't think one should shy away from admitting that. But the precise reason for the return being pegged to the level of risk is that you are getting compensated accordingly. So yes, look out for your risk appetite,
Mhm.
look out for what matches that, what is the time horizon over which you are giving the money. So all of these play together. And if nothing else, I would say people can begin with a risk-free, sort of instrument,
Mhm.
which is buying G-Secs or treasury bills. You at least cultivate that habit of having something in your portfolio which is regular income. I think will start to then, set the benchmark for what you should demand when it's a higher risk entity that you are participating in.
No, absolutely. I remember our discussions when the standard disclaimer that all platforms use. I remember in discussion with you that they may be default or delay in payment, and the reaction which we saw from some of the clients was like, "What? This is a state guaranteed bond, or this is a this?" And you're saying delay and default. But I must give it to you, and really thankfully, because that is part of the education and awareness process. Why do you think our country has lacked that as far as debt securities are concerned? And what could be done?
See, there is that Hindi saying, right? Der aaye durust aaye. So rather than dwell on why have we not reached maybe all of this earlier, I'd rather celebrate the fact that we are
Yeah,
here
we're
and
here.
now. I
Absolutely.
think several things came together. I think if I look at bandwidth and the online nature of being able to do
Yep.
transactions, the digitization that had happened at the back end, maybe at depositories or exchanges and so on. I think all of it makes for a perfect sort of, I don't know, cup of tea for those who enjoy tea. But that is how I would sort of uh, say that where we have reached today. Are there still more miles to go? I'm sure there are.
Yes.
But this entire thing of being able to create a primary issuance platform in form of EBP. Uh, I was, participant in a program, a discussion with IMF and World Bank. And when we described EBP to them, they said this doesn't exist anywhere else in the world. So I think somewhere we have to take credit for the things that we got right and how
Yes.
we implemented it. Yes, we do have a secondary market that needs deepening. And I heard from you before our conversation today about how actually the volumes have jumped up there. Do
Yes,
you
no,
want to?
absolutely. The number of trades, just to tell our audience, is on a trajectory to double this year, this financial year.
So even this thing of saying that secondary markets aren't deep enough, I think again, I'm hoping all of you sort of end up demonstrating that it is not so. In fact, when I was, at another forum talking about it, I think one of the policy leaders sort of came up to me and said, "Why are you beating yourself about it? Look at your largest, sort of investors in the fixed income. They happen to be pension funds, they happen to be
That's right.
insurance companies,
That's right.
and those are hold to maturity investors. They are long term. They are going to not come into the market every day and trade. So if that's the pattern of allocation, that already 60, 70, 80% is absorbed by them,
Yes.
you can't expect them to be in the market and trading. So really it's the other investors which will drive what happens in the secondary market. And I think sometimes we forget that. So we keep beating ourselves up saying, oh my God, the volumes don't exist. They don't exist because there is a set of investors who are not in
Which
that
are hold to
market.
maturity. No, absolutely. No, so very valid point you brought about the EVP. And I've traded in international markets, and it does not exist anywhere in the world. Until today, I have people come and tell me, oh, but in the US, and I'm like, pause, because what we have done amazingly well, and under your regime as well, is reduce the denomination of 10,000 rupees.
Right.
In the US, the minimum denomination is $200,000. So people do not get that what we have achieved in the Indian fixed income market is way ahead as compared to international standard. Even this online platform, it does not exist internationally, and thanks to our technology, which kind of leads it. What do you think are the significant risks? I'm sure as a regulator, when you're deciding policy, uh, uh, especially in terms of online bond platform, what would have kept you awake, saying, okay, if these two three things happens, we are in for a bad ride.
I think main thing was focusing on that. Was it that whether the orders were getting matched off in the own books of the platform provider, or was it getting routed into the market? At some level, could the pricing therefore be off if it was
Okay.
self, a proprietary sort of trade?
So
or
conflict of interest, basically.
Exactly. So I think regulators tend to focus most on how to minimize that conflict of interest. And if it can't be eliminated, then at least making sure that there are checks and balances around it. The migration to, therefore, the RFQ being the mode
Yes.
where online bond platforms do it, I think was a big part of that mitigation. To me, the second, and I keep emphasizing it, is that please don't oversell this instrument. Uh, there are people who need it and who
Mhm.
will indeed take it. But the minute you brand it differently, the minute you give it a safer than what it is kind of label, I think it enters the domain of mis-selling.
Mhm. Mhm.
And I think a lot of engagement with the OBP Association and the exchanges was around how should ads be reviewed, how should they
Yes.
be put out. So curbing this mis-selling was, I think, a very important aspect in dealing with and I think a lot of things have gone right.
Mhm.
What I worry about going wrong, I come back to that it's the primary credit default I would worry about. One bad credit default, one which can really make the investors feel were the people involved aware, and did they sell me a lemon? Or was it that, yes, people took all the steps they could,
Mhm.
and indeed, maybe it's a business failure, maybe indeed it is, the cycle has changed or what have you. I think people are forgiving when it is the latter.
Mhm.
But if they feel they've been deliberately sold a lemon, I think you can expect both angst, and that angst then transmits over to the regulator as well.
No, just talking about defaults, because in large developed markets, there is a natural percentage of default. So let's say a single A rated, you will have a 3 to 4% default rate, annualized default rates. In India, in the last 5 years, we have 0% default rates for AAA segment. And I think it's part of the education process that defaults will happen, right? Because, so-called in equities, we see stocks going down 25, 50%, and people go bye-bye. But somehow this concept that bond hai to matlab paisa to wapas aana hi hai.
I think people should assume that certainly for G6.
No, 100%. That's
That is
risk-free.
risk-free. And
Yes.
I think the minute it is any private issuer, any issuer other than the government of India, I think you have to build in that there can be delays, there can be default. And it is equivalent to saying that if you give, I don't know, somebody a loan, how much is the chances of that loan being repaid? Is really what is playing out on a market wide scale.
Absolutely.
So to me, that is, I think, the risk which people, as you said, sometimes don't pay attention to. But it would be, I think, a critical component of saying, yes, there will be people who could delay payouts to us. There could be defaults. I think as long as the system then picks it up and picks it up in form of workouts, in form of whether one goes to the committee of creditors and the
NCLT, IBC.
exactly. And those mechanisms seem to have worked well for the banking system. There's no reason they should not work well for the bondholders. Again, this is where the role of the other intermediaries, debenture trustee, becomes prominent.
Yes.
To my mind, how are they sort of both communicating? How are they taking the instructions about what to do next? Do they have a playbook of, how to go about doing things? I think this has occupied SEBI as well quite a lot in terms of how do you equip them? How do you so there is, in fact, every issuer contributes to something maintained with the exchange called Recovery Expenses Fund. And that fund is meant to be drawn upon by the debenture trustee if there is a default. Now, whether that is going to be enough if there is a default versus not, I'm saying maybe we need actual events to happen. Like you said, we've been quite lucky in the last few years, past 5 years, that we haven't seen a major default. And that is also a migration to quality at some level.
Yes.
But like I said, there needs to be a credit, cycle across which we need to be prepared for, and there will be defaults, there will be delays. So one needs to.
One thing practice in the industry I must highlight is obviously it's the not so strong balance sheet companies that need funding, and we see a lot of what I would call the lowest rating within the investment grade rating. Right, so there's a propensity that a lot of triple B plus, triple B bonds which are being offered to retail. Do you see any kind of a correlation risk or something that can go wrong in future, or the investor has to diversify within fixed income also? Right.
Yeah, I think indeed across rating categories is the best way to have exposure rather than just build it up around a particular return expectation and
Mhm.
then only staying in one rating band. I would equally say that, and let's not forget, even the US, and you've been a bond dealer yourself, a whole host of things got financed and built on the strength of Michael Milken and the famous
The junk bond empire, yes,
bond
that is
empire
a
that he erected.
classic story of high yield. Yes.
And those were all actually high risk and low rated entities, and therefore the nomenclature junk bonds. Uh, Again, there were people who could make money from those junk bonds. Yes, there was
Yes.
a risk of default. Yes, some risks, some defaults did happen. But overall, did the market benefit, or did the issuers and what was going to be created thereafter happen?
Mhm.
I think those are again things to sort of keep in mind.
I know, Mr. Rao, that 3 years was your term, but there's always some unfinished business, right? You always feel कुछ और समय होता तो कुछ और कर लेते, right? So, or things that move 50%, 60%. And I want to probably stick to the debt markets again. What would you like to see, what you can comment on in the next 2 to 3 years to happen within the industry to make it even more stronger, larger participation to come in with the right guardrails?
So I think for me, amongst the things we did a lot of developmental work around was trying to nurture the municipal bond market.
Yes.
So to my mind, that is very tiny as compared even to our overall debt market, and indeed in the size of economy that we have. And given the rapid urbanization of India, I
Mhm.
think in 5 years' time, 50% of India is expected to be in urban settings. I think municipal bonds have a bright future. How do they sort of get issued? How do we overcome all of the institutional challenges for a municipality?
Mhm.
Whether it's the local corporators who need to bless it, the administration which needs to go along, the state government sometimes which need to play a role. I think that is one sort of, I would call it, we had started seeding it. How far does it go? I think is a matter of something to watch. The second, I would put market making. I think
Mhm.
at whatever level, there were two or three consultations, thoughts to seeing how market making could be introduced. I think again, it's an important component, especially for if we want retailization,
Yes.
that there is always the availability of two-way quote for an investor. How wide those quotes are is a market phenomenon, but at the same time, I think if it starts to gain currency, if there is market makers in corporate bonds, I think one will again see far more.
I think more trust and confidence comes that,
Exactly.
okay, I do have an exit price.
Correct.
Yes.
And this is in parallel to the corporate bond repo platform, which
Yes.
again took shape in the last 2 years. I'm very proud of it because I think, again, the kind of volumes we thought were not achievable. Actually, now they are able to do 30, 40,000 crores of monthly, repo transactions. To my mind, again, that is available as a liquidity point for investors in bonds. Beyond this, I think the third, if at all, and I'm sure I'll be echoing sentiments of OBPs when I say it, which is that distribution network
Yes.
for how to have bonds reached out, akin to how MFDs do it for mutual funds, or how we had this entire concept of sub brokers and authorized persons
Mhm.
now in the equity stockbroking side. I think solving for that would be an interesting sort of infrastructure. I think in the days ahead.
Of course, I loved your last point a lot. Just for our audience, we're a large country, right? So talking about financial education awareness needs a lot and lot of time. And intermediaries and advisors, distributors have played a very important role in equities and mutual funds to the point that the industry is asking for that, saying that can we have a framework where the right person, fit and proper person, can be eligible to talk more about bonds. So some work still left to do, as usually is the case. I'm gonna move away, and you touched upon municipal bonds, and I want to stay away from the bond market. You were responsible or looking at a lot of different things. Which, according to you, are some of the asset classes apart from equity and mutual fund, which have tremendous potential of growth in this country?
The hybrid securities, to my mind, the REITs, the InvITs, and indeed the SM REITs, which came in, which is for fractionalized.
No, we're seeing a lot of traction there already.
Right. So these, again, in my mind, give an investor, like was mentioning, in a portfolio, you should have exposure to multiple things. That balanced portfolio should have a bit of real estate, bit of infrastructure, bit of equities, bit of bonds. To my mind, these real assets, which have got financialized through the instruments of REITs, InvITs, SM REITs, I think I would again want to see how fast and how far do they grow. Uh, I never tired of pointing this out, but really the kind of growth that we saw, the AUM of REITs and InvITs, that it already reached about 8 lakh, 9 lakh crores in aggregation is no small feat. I think credit again to the sponsors, to the financial and developers who brought together these deals into REITs and InvITs. And it's a steady asset class, which again, for whatever reason, I think even in the last board meeting, the classification of them became a question. REITs have now got eligible to be in the equity side of mutual fund schemes, and InvITs continue to stay out. But to my mind, I think that is matter of detail, if you will. I think that investors need exposure to these is probably the way I would put it.
So again, it's about retailization, right? SM REITs, talking about fractionalization of bonds, maybe staying still around the bond thing. We are a $628 billion corporate bond market, which is minuscule as compared to our size of our GDP and economy. Where do you see the future of this? I mean, I know you'd come up with the bonds for Viksit Bharat in your term, and that was very, very, inspiring and energizing. But where do you see in 5 years, what kind of growth that can happen in India?
So, like I said, we had a migration of issuances only to AA and above. I think a lot of the, issuance coming from other rating categories is what can really fuel. And that does require the fuel too. If you ask me, the SME segment, there are equivalent of mid-sized corporations which probably haven't, for the lack of thinking that they are not well rated, come to the bond markets at all. Maybe the private credit funds are sort of addressing that segment, but I would believe that they again are constrained by how much capital they have.
Yes.
Can the public, can all of you in the markets that you create help mobilize far more? I would say yes. I think there is a dramatic potential. It is a potential that can even rival our current size of GDP.
No, absolutely. I think developed markets, corporate bond markets are 50% to 80 to 90%. And I'm just talking about corporate and not the bond market. So Pramod, it's been very exciting, talking about the bond markets, talking about your journey in the regulation side. But I think people want to know who is Mr. Pramod Rao, right? So there's always this wall of, and naturally so when you're a regulator, this section is called a rapid fire section where I'm going to ask you a few questions, and whatever comes first to your mind is really your response. One asset that you invest in.
Mutual funds.
Views on crypto.
Skeptic.
One must-read book on finance.
I'm right now reading 1929. Fascinating so far.
That's about the Great Depression in the US.
Andrew Ross Sorkin's latest book.
Yes.
He had written also about the GFC, which again was my personal favorite before this.
Yes.
But yeah, 1929 is the one, right?
No, very fascinated. I lived through the GFC times. I was a trader then, but I can't wait to get my hands on that book. If not finance, what would you do?
Lawyering.
If not lawyer, what would you do?
I would be hamstrung. I think I would have been, I don't know, doing something around reading or whatever. I think maybe academia.
Okay. How do you relax?
I read a lot.
One hobby, not reading, that you can talk about.
I have a collection of stamps, which takes many people by surprise. So I collected stamps as a child and then had to give away my collection whenever we moved. I think my parents made me get rid of it because it was too large. So when I turned 40, I said, let me pick this up again. So I now have another set of collection that I have built.
Favorite holiday destination in India?
In India, it's usually the hills for us. So that's last we went was Shimla.
That's great. One thing we really want to know now, after it's been about 3 months since your last stint at SEBI, what's next in store for Mr. Rao?
Well, the good part is I'm still figuring. What am I figuring? I think it'll end up being around advising, consulting. There is a bit of also a passion project that I have nurtured. I've just completed co-authoring a book.
Oh, amazing.
It's on the in-house space that I spent 25 plus years in. So to me, that will be part of maybe, I don't know, sharing with the next gen of GCs and legal heads what they could look up to. And as many people have remarked to me in my conversations in the last 3 months, the world is your oyster.
Absolutely.
So I now just have to find that pearl. So yes, that's where I am at.
Since this conversation is about finance, I do have to ask you, what does your portfolio look like?
So primarily, I'm, like I said, invested via mutual funds. I think it's almost a 50-50 between those that are equity growth oriented and fixed income debt schemes that I have. One tends to then, when the balance shifts thanks to market phenomenon, then I just go about correcting it. I think, again, the products that I have sort of recommended form part of a balanced portfolio, also form part of mine. So looking at few REITs, few InvITs, and those, if they come through a mutual fund offering, I'll be the most happy. Which now with all of the reforms, I'm hoping that becomes part of my portfolio too.
I think it's so important to talk about a balanced portfolio and really globally when we do asset allocation, it's about fixed income and equity largely. And we do see, someone like you practicing that. It's very nice to see. Now, it's not often, hopefully this chat will be seen by, as I said, lakhs of our investors. It's not often that people get to see and hear your views in a candid environment. What are some last thoughts you want to leave, a normal bond investor starting his journey or doing through these platforms? And the regulation you brought about as to what would be your words, kind of parting words to those people?
I think it is hard-earned money that we all put into investments, whether it be equity, bonds, whether it will now be instruments like REITs, InvITs. I think do your diligence, and where you don't have time to do your diligence, please engage with professionals like investment advisors, or entrust your money to portfolio managers, mutual fund managers, and so on. I think it's important that diligence forms the basis of what you put your money to work for. Yes, be prepared for shocks and surprises. Equities have a better way of delivering surprises. The prices can really rise. But shocks are also obviously there, where stock market, the prices can dramatically correct and go down. In bonds, it can be the expectation of saying steady returns, but yes, be prepared for delays or defaults. In REITs and InvITs, while I keep saying that they are a proxy for the real world, the real assets that you have, COVID has shown us that people might just abandon working from offices. And if REITs house office premises and people stop going there, they may also stop paying rent or renegotiate and so on. So yes, there can be even a downward, impact there. InvITs own quite a lot of road highways and so on. So again, during COVID, the traffic fell, right, dramatically. So I think be prepared for that downside that can come. When it comes, nobody will know. But I think in a balanced portfolio, which is what the aspiration should be, is have components of each of these. And wherever it goes out of sync of your balance, correct it. I think that's the kind of thing which I would recommend. Again, like I said, it is hard-earned money. I think it should be hard at work for you. And if you keep diligence around it, I think it will be quite good.
Very well said. Like a true regulator, ex-regulator, warning about risks. But indeed, Mr. Rao, it's been a pleasure talking to you. It's not every day that we see someone who's been very, very active, or as I say, the big brother of our industry, to come and speak about your views. It's actually been an honor to host you, and we wish you all the best in everything that you do, and definitely look forward for our paths crossing in the future.
Thank you.
Thank you for being with
again,
us today.
Vishal. Thanks so much.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and/or default in payment. Read all the offer-related documents carefully.